Good evening from Money Matters TV. I'm Paul Sloate, CEO of Green Drake Partners, and with me tonight is Paul Mitchell from Republic Bank. How are you tonight, Paul?
Terrific, Paul.
So, it doesn't seem that we can go a month without something happening internationally.
Well, I'll say, and big stuff, world powers.
World powers sort of stuff. So, what do you think about what's going on in Ukraine?
Well, it's a little hair-raising, but historically, it's happened many times before. And I think that's what we have to remember. This is not an unusual type of situation with certain people rattling swords and taking a territorial approach to each other, for their own interests and testing other world powers.
And what do you think is going to be the ultimate outcome here?
Well, it's a speculation. I can't exactly say I'm an international expert, but I would say that Russia will probably have more influence on the Crimean Peninsula. I mean, it already has bases there and has Russian-speaking people. Defense is a big deal, and you want to protect your defense bases just as the U.S. and other countries protect their defense bases around the world.
Yeah, I would agree. I mean, just like Russia has its major naval base in the Crimea, the U.S., if we remember, has a base on Guantanamo Bay, which is actually part of Cuba, which America controls. So this would not be dissimilar to what the U.S. does around the world. It's almost like the pot calling the kettle black.
Mm-hmm. But one of the other things you have to keep in perspective is that sometimes these things can start out a little small, and then if let's say Russia gets its way too easily, then it may have temptation to do another similar thing somewhere else close by, etc. Just as we, years ago, we used to worry about the domino effect. First one little piece, then another little piece.
Yeah, so I expect there's going to be a lot of noise about this over the next couple of months.
Yeah, and certainly we've seen it affect the financial markets. If there's a crisis, the financial markets get scared, the stock market may drop significantly. The crisis eases, stock market goes up. So, I mean, here we are, 4,000 or 5,000 miles away, and, we're being impacted. So I think people should, the other thing, I think people should read the news, stay abreast of it. It isn't something that just is happening somewhere else around the world. It really impacts us directly.
So why don't we talk about lending? You're a senior loan specialist. What do you see going on in the world of lending today?
Well, I see it picking up, and I see bank and lender standards easing somewhat. It's all relative to where it was, 2 or 3 years ago, which was really stuck in the mud. So, and businesses have a little more confidence. People are talking about, buying another business or buying a franchise, taking the risk. Buying franchise frequently involves taking a second mortgage on one's home, for example. And people are willing to do that, looking ahead with a degree of optimism. So it's definitely improving. The other interesting thing about lending these days is it's been a trend over the last few decades. Traditionally, you think of banks as being the source of lending. Over the years, you have the bond markets have gotten bigger, commercial paper's gotten bigger. You've gotten hedge funds getting involved in lending. You have the commercial finance industry, kind of grew out of nowhere, and now is a huge industry. Now you read about other things. I was reading today about peer-to-peer lending. I don't know if you're familiar with that concept.
No, I'm not.
Well, that's where over the internet, I have money that I want to invest, get a better return than 0.2% in the bank account. You're interested in borrowing money. We are introduced through an intermediary over the internet, and I end up lending you money at maybe 5%. Okay, you get a loan that's fairly attractive. I get a 5% return. This loan is managed by somebody who's supposed to be an expert in this stuff. It's sort of invading traditional bank markets. To me, it sounds pretty scary because who is the expert that's managing this? They can assume it's going to be a 3% default rate. What's a great assumption? Based upon what? You're going to find out in 2, 3, 4, 5 years. You're definitely going to find out when there's a blip in the economy.
Well, yeah, whenever we have the next recession, you'll find out how good the underwriting really was.
That's right.
But until then, nobody knows.
And it looks kind of rosy. There's also you read about the business development companies, another concept that has sort of been growing. Again, these are unregulated entities, unregulated. banks are regulated, so banks have a lot of compliance issues to deal with, and they're overseen by the government. These other entities, there is no regulation, so a lot of assumptions are made.
Well, that's similar to what happened in the 90s or what happened in the first half of the 2000s. You had a growth in these entities, and then what happened is when there was a recession, you had a massive shrinkage because it turned out a lot of the assumptions they made weren't correct.
That's right. That's right. So I would still advise people to be careful, do as much investigation as you can, get references, talk to other people that dealt with these entities, et cetera, et cetera.
Okay, but if you're looking for money, these might be a good place to go.
There could be here's a generality. It's more expensive money than from a bank, but it's looser. Now, if you can stomach that and think that's going to work for you, give it a shot. But there's some risk involved. Some of these things are a little bit untried.
Okay, so lending's loosening up. Mm-hmm. The equity markets seem to be hitting new highs.
Yeah.
So what do you see going on with the equity markets here?
Well, I guess the standard response to that in the last 10 years has been cautious optimism. I'm sure there are a lot of good indications that things will continue to progress, go in the right direction, go upward. I think we still want to be very cautious about seeing any kind of too fast movements, too dramatic movements, because the markets are efficient and they will correct themselves.
Yeah, the markets do tend to correct themselves over time, and they did have a big movement last year. Tremendous movement last year, and we've actually cautioned our investors to expect lower returns, much lower returns this year than over the last few years. Most people don't realize over the last 5 years, the equity markets are up 170%.
Wow.
And so people forget that those kinds of returns are not sustainable. Mm-hmm. But it's always interesting how the public starts putting money into the equity markets after the 170% returns, but not before.
Yeah.
It's
well, it's certainly tempting. I mean, the bank rates still are really, really extremely low. I mean, it's hard to imagine. 0.2%, 2% for a 5-year commitment of your money. Unbelievable. So you got to do something. People are tempted or pushed to do something else than just leave the money in the bank.
Correct, and that won't change until the Federal Reserve really starts to raise rates in a year or two. Mm-hmm. Let's talk about oil and gas. What do you see going on in oil and gas?
Well, the trend has certainly been the gas reserves that have been discovered with the shale reserves in Pennsylvania and in the Midwest. Just tremendous amounts of energy, to the extent that we're actually exporting energy. I understand. Oil, is still secondary, but there are new discoveries of oil fields around the world also. Gas is still, I think, a better deal for the consumer, and you'll probably see more mechanical uses of gas, whether it's vehicles or in factories and plants and that type of thing. Energy, creation, electricity generation.
Yeah, we're seeing businesses, especially industry, using more and more natural gas, and natural gas vehicles should grow, even expand into the trucking area. Cummins Engine, who's actually the largest manufacturer of truck engines, has stated by 2020 they expect a quarter of all the engines they sell to be run by natural gas, not diesel fuel, which is kind of interesting. And so we expect natural gas demand to grow. We've also said that we had recommended natural gas to our investors when it was $3 because we felt that was an unsustainably low price, which has been proven this winter. Now, it may have gone a little too far, too fast, and we expect the prices to come back. But we think natural gas is an investment. It's a good long-term investment, especially because of the growing uses, which you pointed out, and also our ability to export it via LNG. Mm-hmm. So we see natural gas prices doing well over the next 5 years.
Would you venture to say that we're not going to have an energy crisis in the next 5-10 years?
Well, that's hard to know. There's a chance that the United States could get to energy independence based on growing ability to produce energy and also on the fuel efficiency that's been imposed on the auto industry. People forget that there were these massive fuel standards imposed on the auto industry, which are actually very good for the U.S., over the auto industry's objections. But if you actually looked at the standards, all they assumed was about 3% productivity growth per year, which is about average productivity growth over a long time. So if the auto industry improves that over 10 years, that adds up to a lot of improvement in fuel mileage. So we can grow the number of miles driven and actually see the amount of fuel we use shrink.
Wow.
So at the same time that we're shrinking our fuel usage, we're seeing our oil production growing, and we're also seeing natural gas liquids and other types of energy production grow. So all that together gives us a chance to be close to energy independence by late this decade, which would be a very different place for the United States and might actually change how we think about foreign policy if we didn't need to have a lot of assets in the Middle East, for example.
Sure, sure.
So has a lot of implications long term.
How about other commodities, such as maybe gold?
Well, we've been kind of neutral on gold for the last couple of years because we've thought of commodities as having entered a big trading range. The big boom in commodities, we turned bullish on commodities in the late 90s. And then we kind of turned neutral around 2006, 2007, when commodities had that big run right at the end into the recession. And we thought that the price had gotten out of kilter with the economic reality. So if you look at consumption and what it cost for the energy, it had gotten high enough that it was going to encourage conservation and encourage people using more fuel-efficient machinery. So demand wasn't going to grow as fast because of the real price of energy had gone up so much. So you could see the factors were in place to do that. Plus, if you looked at what it cost to get it out of the ground, you were going to get it out of the ground much, much cheaper than where the price was. So we felt that the two had to come much closer together. And so we think that whether it's gold or whether it's oil, a lot of these commodities are in big trading ranges. Some commodities are going to be in surplus, like copper, because copper has too much production coming over the next couple of years based on global demand. And you have to remember with China, China's been the big incremental source of commodity demand. They now consume over 50% of many commodities globally, and their level of investment is unsustainably high and has to slow over the next few years. And as they move their economy more towards consumption, consumption growth is 1/15 as commodity intensive as industrial growth. So what's going to happen is their economy can continue to grow, but their demand for commodity growth could dramatically slow at the same time. So you have to be a little careful not to confuse commodity prices with what's going on in a place like China, because they may be two different things. So we've turned kind of neutral on commodities. We think you can have cyclical moves in various commodities. And in fact, we had an investment in silver for a while that did quite well for us in a number of silver companies. But we think it's going to be picking your spots carefully over the next several years and really knowing the fundamentals of individual commodities. We don't think there's going to be this broad-based commodity boom again because of where China is and where many of the other emerging markets are. So we think the world's changed a bit. So what do you see going on in housing, Paul?
Well, the reports are kind of up and down month to month, but I think the longer term trend is still, it's got to go up. New housing going up, individual houses. Certainly, the multi-housing industry has continued to grow dramatically. Certainly, seen it a lot of growth in this area in southeastern Pennsylvania. See it in the city and see it in the suburbs.
All right. Well, unfortunately, it's time for our question from the viewer. And our question from the viewer today comes from Mark Hellman in Exton, PA. And his question, and this is a perfect question for you as a banker, Paul. How secure is online banking? And if somebody hacks my account and wipes it out by draining the account, am I protected? And if I am, who reimburses me for the money that disappeared from my bank account?
Sure. Well, that's an excellent question. I mean, this whole issue of cybersecurity has gotten a lot of play in the press. I mean, there have been some dramatic incidents. It's something that people have to worry about more and more whether it's even from the national security level, let alone the consumer level, to stores or banks. Talking about a bank specifically, there are two kinds of, I'll say, perceived online banking that are really involved. One is the use of one's debit card. It looks like a credit card, but actually it's attached directly to your bank account. And there are specific laws and regulations that cover the use of the debit card. If your debit card is misused, that if somebody else gets the information and uses it somehow, you are protected as long as you inform the bank within a few days. You may be at risk up to $50, but generally speaking, you're pretty well taken care of by the bank. That's the debit card. That's not what banks would traditionally would call online banking.
Correct.
Online banking, especially used by businesses, is where you go online and use passcodes and that type of thing to initiate transactions. Wire transfer
Correct.
would be a little more old-fashioned way of describing it. Works the same way. Now you can just do a lot more movement of your money within a bank and to other payees than you can with the traditional wire transfers. The bottom line question is there is risk involved. The best way to define that risk is to read your agreement with that banking institution of what is covered, what they're responsible for, what you are responsible for. Generally speaking, I would say that most banks will say at the bottom line is that you have a risk. Now, there are also two kinds of risks there. One is if you do online banking, you're using two kinds of, I'll say, machines. One is yours, your computer, your phone, your whatever. If somebody hacks into that, why should the bank be held responsible for that? It can't possibly. It has no control over it. If you are lax with your own security procedures, doesn't it make sense that you would be at risk? So there's that aspect of it. So I would say there, people should pay more attention. Businesses should pay more attention about, what kind of risk and security are involved in their own equipment, if you will. The other side, of course, is the bank itself. If somebody hacks into the bank system and somehow diverts $500,000 of your company's money somewhere, again, read your agreement. The banks generally are very secure. Now, there's another aspect of it. Well, maybe a little bank, how could that be as secure as a big bank? Well, big banks will do their own security internally with, I'll say, large staffs, spend a lot of money on it. Small banks rarely, if ever, do their own internal security systems. They contract with a company that is in the business of dealing with dozens, hundreds of banks. So that contractor is a pretty sophisticated contractor, and their security systems are quite good.
Okay.
So there is definitely risk involved, and it's a very good question. There are insurance policies out there that you can buy, not only specialized ones for specific types of transactions, but in general, transaction risks.
Okay. So the answer is caveat emptor
Yes.
for the business,
Right.
but for the individual,
On the debit card,
right?
you're pretty well covered. Your
they're pretty well
responsibility is
covered.
if you don't report it to the bank for 2 weeks,
There's a difference.
Yep.
But if you report it right away, you're covered.
that's right.
If you would like a question asked on our show, please write to Money Matters TV, 205 East Levering Mill Road, Bala Cynwyd, PA 19004, or email us at moneymatterstv@gmail.com. And now it's time for our guest tonight. Our guest tonight is Chuck Steege, who is the founder of SFG Wealth Planning Services. And my understanding is you have an RIA called SFG Investment Advisors, through whom you actually offer your services.
Correct.
Okay, so maybe you can tell us a little bit about what you do, and then a little bit about, you're evidently a specialist in executive comp, and maybe you could talk a little bit about that.
Thank you very much, Paul. I appreciate your having me on your show. So we are a firm that helps senior level corporate executives of public companies primarily navigate towards financial peace of mind. And specifically what we do is we specialize in helping them to deal with the complexities that normally come about in dealing with their stock-based compensation. And stock-based compensation comes in a whole variety of forms. So that's what we do. We work with really the best and the brightest, but they lack one thing generally, and that's time. Time is their greatest commodity, And so we're there to help them deal with untangling and understanding all the moving parts.
Could you give us maybe a little example, a story of a situation you ran into in the last few years where the kind of compensation that was involved, and maybe if it wasn't handled as best it could, what happened, what the implications were?
Well, oftentimes there are tax time bombs with certain forms of compensation. So, for instance, incentive stock options. Oftentimes executives are so busy performing for their company that they might approach an expiration point with their option and they quickly divest without a whole lot of planning. So it could be that they convert what would normally be or could be a 20% long-term capital gains event to a W-2 event that would push them well into the 39.8% bracket or 39.6 plus the 3.8% health insurance tax. So just by some simple planning and some forethought on how to divest, they don't have to pay that 20% differential between a long-term capital gains tax rate and their ordinary income tax rate.
So if we were to look at that, give us, what are some of the differences between, let's say, stock options, restricted stock units? You get restricted stocks, there's performance shares, there's stock appreciation rights, there's this, ESOPs, there's, and I could probably list a half dozen other things which I haven't mentioned that an executive could get as part of their compensation package, and each one of these has different implications and different, tax consequences.
Yeah, so there's generally three major categories. There are time-based awards, there are performance awards, and there are broad-based awards. Let me talk about the time-based awards. Time-based awards are, for instance, stock options or restricted stock or restricted stock units, where an executive is granted those options or those grants, and after a period of time, those options or those restricted stock units or restricted stock vest, at which point the executive takes possession of the value of their company's stock on the day of vest. Another form of time-based would be a stock option, where an executive will have to wait until there's a point of vesting, and presumably the value of the stock itself has exceeded a fixed price point at which they can buy or exercise the right to acquire the stock. So those are time-based. Performance-based are really tied to a company's performance, whether it's revenue, whether it's earnings per share, tied to some kind of performance metric. And then finally, a broad-based plan would be an employee stock purchase plan, where it's not just the executive of that company that benefits, it's a large number of the employees of the company. So everybody is able to participate in the growth of the company. So time, performance-based, and broad-based.
You'd mentioned that this is mostly for public companies. Is there an application, though, to private companies?
There most definitely is, and unfortunately a lot of private company founders aren't tuned in to some of the immediate tax benefits, things that they need to act on fairly soon at the time that their company launches. But most definitely, private companies will oftentimes issue non-qualified stock options, as an example, that allows that founder, that business owner, to receive a grant and in some cases be able to exercise soon after the grant.
You said non-qualified.
Yes.
Maybe you can explain for our viewers what's the difference between qualified stock options and non-qualified stock options.
Great question. And so an incentive stock option is an example of a qualified stock option. And the value of an incentive stock option, as I mentioned, has favorable tax treatments if the executive plays through the scenario where they exercise and they hold, preferably 1 year and 1 day from the date of exercise, where they can ultimately sell and realize a long-term capital gain. That obviously assumes that the stock continues to rise after the date of exercise. A non-qualified stock option is one where upon exercise, the full value or the value above the exercise price is subject to W-2 income. A qualified incentive...
W-2 income means straight compensation.
Straight compensation.
Higher tax rate.
Correct. Ordinary income taxes and the health insurance tax, Social Security and FICA tax, all of that would apply in any time there's a W-2 event, which would be the case with a non-qualified option. All those taxes are incurred, whereas a qualified incentive stock option has more favorable tax treatment.
I understand that public companies are under ever increasing scrutiny as part of the shareholders and regulators, et cetera. Are there any specific aspects that a senior level executive, particularly a corporate insider, would need to be mindful of when it comes to their stock-based compensation?
Most definitely, and obviously you as an investor are going to be very concerned, as many large shareholder groups are very concerned about what executive behavior is, if you will. Companies have been increasingly more cognizant of the need for corporate governance. And so obviously, if there's a named executive officer, somebody who's categorized as a Section 14 or a Section 16, a senior level executive in the eyes of the SEC, they should already be very mindful of what they can and cannot do. So for instance, they cannot sell when they're in possession of non-public information, and they need to wait for open window periods, usually after an earnings report has been rendered. So there are also internal filing requirements on the part of the executive. When an executive is appointed, when an executive is granted, or when they make a certain sale, when they gift to family members, they have to make those required reportings.
And those reports are all public. I mean, as an individual, I could find that out if I wanted to look on.
Absolutely. You
some
can
public
go to the SEC website, and you can look up specifically insider activity. This has to be widely disseminated information, so anytime you see a grant being made to an executive, anytime you see a sale of a position being made, that's all public. Absolutely.
So maybe we just have a little bit of time left. Maybe you could talk about the most common forms of executive stock-based compensation plans and why executives choose that given the tax implications.
Okay, so the most common forms have been time-based compensation, but there is a move towards performance-based compensation. Why is that? Well, the answer is that shareholders really want to make sure that their interests are aligned with. And so the more common, especially for the most senior level C-suite, the CEO, the CFO, much more of their compensation is really based in performance. What are they doing in terms of increasing top line revenue? What are they doing in terms of increasing earnings per share?
Share price, sure.
Share price, EBITDA. It could even be customer satisfaction, operational efficiencies. So all those metrics have to be met prior to any kind of reward being granted or vesting.
Okay. Well, unfortunately, we're out of time for today. I think we could go on for another half hour easily on this topic. But our guest next week is Phil Heifetz. He is the president and CEO of IIC Inc. They are a venture capital fund focused on biotech companies. And from all of us here at Money Matters TV, your money matters.